Good morning and welcome to our 10 minutes at 10 for everybody. Today we are going to talk about your chart of accounts. Super important, far more important than anybody realises.
You can add so much value with your chart of accounts, it's unreal.
Or you can really mess your accounts up if you get it wrong.
Yeah, there is two ends of the spectrum.
So, what is your chart of accounts? Your chart of accounts are all the account codes that you're using to measure and manage your business accounts. So it's made up of profit and loss accounts and balance sheet accounts. So we talked about debits and credits and understanding those yesterday so that you know which side things should be in. But what about the actual chart of accounts itself? Well, most software systems have a standard chart of accounts, so you do at least have a template to work from. You've got profit and loss, which is your income less your direct costs, less your overheads, which gives you a direct profit. So you've got all of the account codes that fit in there. And your balance sheet is all of your assets and your liabilities. So all of those account codes are sitting in your balance sheet. Now, really important to make sure, even if you've got a standardized set of accounts, that you've customized that, even if it's just a little bit, to make sure that that set of accounts works for you. So, for example, don't just have all of your sales going to sales. Customize your sales accounts so that you have 1, 2, or even more different sales accounts to track all of your different types of sales in.
You'd be amazed how much value that adds. Because then if you can track the income streams or the product or the services, you get much better overall review of your business performance. It's so much better.
Yes. So you're looking to future-proof your chart of accounts really so that your management accounts report things that you can then measure. So you should be able to edit, add and update your chart of accounts in your software system. And the idea is that you want to manage what you measure. So you need enough sets of account codes in your chart of accounts to be able to manage what you measure or measure what you manage. So that's, look at it from a perspective of if it's important enough to you, or if it's a cost that you want to control or an income that you want to measure, you need an account code for each one of those.
Less is definitely not more with your chart of accounts.
I think so.
Yeah, I completely agree personally. I think less is definitely not more. You don't want too many generalized codes. You don't want codes that don't give you enough detail. So make extra codes if you don't already have. If you're using the standard one, add some extra codes in. Make sure they're specific enough to give you detail, but not so specific that they filter out the account code and stop it being used for anything other than one transaction.
Yeah, exactly.
So printing and stationery makes a good example in this one. Basically, printing and stationery is a default account code, as you'll find in most accounting systems. You could split it out into, say, printing and stationery. But then, why would you split it out into, say, pens, pencils, paper, ink? It just becomes a bit overkill. What you end up with is a load of account codes which you don't really use. So split it out into just enough detail, but not so much that you close the account code to other transactions.
Well, if it's too long, all of a sudden your profit and loss account is like, you know, £5 on this and £3 on that and £10 on that, and then it's just silly.
And then
so you've got to be sensible.
Yeah. Actually makes it more difficult to track your P&L if you split it out to too much detail.
Yes. Now, most accounting systems will allow you to have default codes per supplier. So if you always buy telecoms from BT, then you can default your account code or your supplier code to that account code, which then makes it easier to make sure that you don't make mistakes in tracking or analysing things later on. Another thing that you can use your chart of accounts for is default VAT codes. So if you're using Xero, for example, you could use an account code for postage, which almost never has VAT on it. A courier cost often has VAT on, but a postage cost doesn't. So you could set your chart of accounts so that those codes that don't have VAT on as normal are always going to be exempt or no VAT accounts. One place where this is really useful is with software costs. One of the common errors that we see when we're looking at a set of accounts is people claiming for VAT on things like Dropbox or some of the IT costs that come through your accounts, I can't think of any offhand, but Google charges
loads of different software costs.
It's often the American, US dollar ones that come through the accounts, and you've set up this particular service, you've brought that transaction through your accounts, and then you posted it as a direct posting. It's a quick fix to post it to the accounts, but often VAT is claimed in error. So that's the kind of stuff that you want to look at, and you could have them auto coded so that they go to you set up a bankroll, for example, so that those ones that don't have VAT go to a non-VAT software account code, and those that do have VAT go to a VAT software account code. And that makes it a lot easier, especially when you're checking for your VAT returns, to see which ones should and which ones shouldn't have VAT by default.
Makes your life much easier, reduces the chance of error, and it means your P&L is accurate as well. And actually, it's quite handy to have them as two separate account codes, because then you can see what your various subscriptions are. Otherwise, you end up with like a single code, and then when you open it, you might have like 10 or so subscriptions. It's harder to track which ones you're still subscribed to, etc.
Yeah, and another way of using that is we often have expenses, for example. So say your directors are pottering about quite often. There's a lot of expense transactions going through. If they don't provide the VAT receipt, you could post that to subsistence no VAT, and that's effectively a control account, so that you know that anything in that account code hasn't got any VAT, and you can use that to ask your directors or the other people in your business that are spending money without collecting their VAT receipts to be able to go and find those VAT receipts later. It helps you monitor how much VAT you're potentially losing on things that you're not keeping the receipts for, whereas everything that's in your subsistence VAT account or training VAT account or IT VAT account is sitting in there, and it's in your P&L, you've recovered the VAT, and that's the best possible outcome for your profit and loss account. The ones with no VAT are ones that you want to keep an eye on, and the ones that you might want to have in your watch list, and the ones that you want to be reminding people that they need to find the receipts for, and are the worst case scenario, because that's the gross cost without the VAT taken off.
Now, because we've mentioned that it's worth adding a few extra account codes, the other thing to consider, especially if you're using systems such as Xero, QuickBooks, etc., is to use account groupings. So if you're adding all these extra account codes, you end up with a few in subscriptions. Ideally, we want to have these grouped together so that we can see trends. So we may have account groupings in our P&L for items such as cost of sales, which you may already have by default, but you may not have that in overheads such as staff costs, premises costs, travel and subsistence, and motor expenses. So add account groupings into the layout of the P&L report and group like-for-like transactions together.
Makes
really
it a lot
useful.
easier to read, doesn't it?
So much easier to read, so much easier to identify when something's missing, and really helpful actually if you're actually providing reports to, say, external parties. If you have two layouts, you can have one layout which is detailed and one layout which is summarized.
So you use your detailed one inside the business for managing your costs and tracking your spends, and send the shortened summary versions outside the business so that you're not giving too much away. Yeah,
really helpful, and it takes very little time to prepare. Once you've got it set up once, it's just changing between layouts. It's really helpful, and it makes it easier to track your expenses on a monthly basis, quarterly basis, however you do it, because not only are you looking for trends between the actual individual account codes, you can look at the group trend as well. And I find that stands out a lot more when you've got big dips, because you might have one area in your business, say premises expenses, where actually the rent account code looks all right, but actually the service charges, you might have insurance in there, which is unique to your premises, and they fluctuate. So the overall group fluctuates, and then you can pinpoint exactly what's causing the problem.
Or you might see that you've got an insurance cost that's come in, but you haven't deferred it over the year. So again, using that level of detail helps you to spot things that, not quite right, but you might have forgotten about. So now let's talk about tracking. Most accounting systems, Xero and QuickBooks, have project codes or tracking codes. So this allows you to take your analysis of your P&L into that next level of detail. So perhaps when you're looking for the profit in your P&L, you can be looking at tracking sales, so you can see where your sales trends are, but you could use tracking codes and perhaps look at where each product is profitable, or where each customer is profitable. Depends on how many customers you've got, and it depends on how many products you've got, as to whether you would try and analyze these in your chart of accounts and look at it vertically or horizontally in your P&L, or whether you can then use tracking codes and slice and dice things in a slightly different way. So there are multiple options for tracking and analysing in most sets of accounts, most systems.
Yeah, it makes a really big difference. In Xero in particular, they'll have 2 different fields for tracking, and in QuickBooks, they also have the same as well, which is quite handy. They go by slightly different names. In Xero, they go by tracking. In QuickBooks, they go by, I think it's locations and classes.
But it's really the same thing fundamentally.
Same concept,
use it in different
makes
ways.
A massive difference. And what it means is you can analyze your P&L based on, say, account codes, but then also by tracking code as well. And if you have the 2 working in conjunction with each other, you get really, really strong reports.
Yeah. Now, one of the things you've done in the past is for some of our clients, you've been able to enter budgets at manager authority level, so different types of budgets, which allows you to then give P&L versus budget to different cost centers in for some clients, and that's really handy if that's the level of reporting that you need to go into. So you'd have to think about how to structure your chart of accounts, not only to be able to report your spends as a business, but also to be able to track any departmental or operational overheads or costs or departments, depending on what you want to report in your business. So sometimes it's easier to try and map out what you want on a bit of paper or a spreadsheet. If, like us, you just like to dive straight in, we do all of our mapping out, and we build the P&L and different versions of the P&L in QuickBooks or Xero, depending on what the client might actually want, or depending on what we're trying to measure.
Now, some of these sound like they might be quite complicated to put together in practice, but there are some. They're not actually complicated to put together. But the reality is, there's some really, really quick wins with your chart of accounts of account codes, which some people might not even put into place or might not necessarily thought to put in place. So items such as doing your recharges. If you had an account code for sales recharge and then costs to recharge.
You're obsessed with recharges.
I love recharges. Basically, when you've got the 2 account codes together, if you have a group in your P&L report where you can see the 2 side by side or one above the other, you can identify when anything's missing. Really, really quick win. Another one is when you have corporation tax due. Now, we provide for corporation tax on a monthly basis.
Yeah.
And 9 times out of 10, what I've seen in the past is, say, if you have one liability account code in your balance sheet, it looks as though you've got corporation tax due and it just keeps growing. And if you cross over financial years, you can't necessarily identify how much is due for this year, how much is building for this year.
Or when it's payable.
Exactly. So we add account codes in, say, corporation tax for the financial year March 2019, and then we would say due by the end of the year,
and then put it in the watch list, so
exactly
it appears at the top, so that every time you're going to your Xero account, you can see what your tax liabilities are and how your corporation tax is accruing for the year gone and that's already been accrued, and the year building, which is being accrued. And then both of those will have payment dates or due dates in to show the reader of the accounts when that corporation tax is due. So again, if you set that up in the chart of accounts right at the very beginning, it's much clearer to see what happens. Now, we do the same with VAT arrears, don't we? So if there are VAT arrears, so you filed your VAT return, but you or your client hasn't been able to pay your VAT, then we create another account code, put it in the watch list, and show what the VAT or the PAYE arrears is, and we journal that amount out of the standard accounts into a ring-fenced arrears account. And that's really helpful to make sure that you as a business owner or your client as a business owner can see what's outstanding at a glance and what the current balance of that is. And
when you add the account codes, I find, like, with corporation tax, say you have an account code for corporation tax liability, it's like 650. If you add it as 651, 652, 653, you end up running out codes quite quickly. So I personally do 650 underscore 01. And if you do it like that as your account code, then you can add loads and loads of different groupings. Really useful things like V80, where it starts to get a bit busier if you're grouping them by quarters. And then as time passes on, you just archive those account codes that you don't need anymore, that are sort of timed out, and then carry on going. And then you stop yourself posting to them in error. So the other thing that is really important is your director's loan account. So whether that's your director's loan account or your client's director's loan account,
trying to make sure that that is clear, clearly controlled, people understand what it is. So we always make sure there's a director's loan account for every director in the business so that everybody knows what their individual balances are, not just a global director's loan account. I don't think that's particularly helpful.
Really, really useful. In fact, I'd say vital if you've got business with multiple directors with different share splits, who are just taking different lumps of money. We do have this with some clients, and obviously if you've got it all grouped together, you don't know who's responsible for what. But if you've got it isolated out and you have a low shareholder who's taken a lot of money, all of a sudden it completely changes the picture, because they're not entitled to as high of a proportion of the overall dividends as the rest. So really important.
So actually, that's another point on the director's loan account. Sometimes it's quite useful to see what the director's loan account balance is, what the dividends are that have been declared, especially if they're declaring them quarterly instead of annually. And that again helps you to see cash out versus those that have been drawn versus what's left over that needs to be covered by a dividend. So we don't do that in all businesses, but we do that in some, don't we, and break it out into that level of detail. Also happens where clients have expense accounts.
Yes, expense accounts are a really, really good one.
Yeah.
And you can isolate them all out and make it so much easier to track what's going on.
So as a quick summary, in your chart of accounts, we firmly believe that more is more, and it's far more beneficial to be able to recognise and view and manage a bigger set of accounts than a smaller set of accounts. But when you're producing reports to people outside your business, you shrink them up and you summarise them so that they see less rather than more.
Yeah.
So thank you very much for joining us on today's 10 minutes for 10 for everybody on the chart of accounts. If you're in the Bloody Brilliant Bookkeeping Club, then you can join in and log into your today's workbook and go into this in a little more detail, take a deeper dive. And if you're not, please join. We'd love to see you there. So take care, and we'll see you next week. Bye.
Bye.
And we're ending. Let's go back and that one.